Today we are going to talk about 3 ways that oil prices can affect your investment decisions. So the first is that when oil prices are high, inflation is high. This can put pressure on profit margins. It can also make investors seek investments that are inflation hedges. The second effect is that the current account deficit widens, in which case your yields on government securities will also rise. The third effect of high oil prices is rupee depreciation. So again, here investors would look for store of value assets like gold and silver. Join us this Saturday for a webinar to know more about how oil prices affect your investment decisions.
Friends, we are back to our conversation with Subhra, and we are going to start with a very interesting topic: making sense of small caps. What really happened? Let's now talk to Subhra. Subhra, welcome back. Pleasure talking to you.
Thanks.
So let's start by discussing what really went on in small caps in these past 3 years. What is your sense? I'll start with your sense.
Largely, there is a huge community which thinks that if you are an advisor or you are listening to some influencer, you think that all the value add is going to happen only in small cap and mid cap. So you can take some historic data over 20 years and say you will get an extra 1% or 2%. This may sound small, but over 20 years this is huge. So there is every newcomer who comes in is told that large cap is dull and boring, nothing great is going to happen. Everybody knows the HDFC Bank and SBI story. You are going to find value in Equitas or any of the newer companies which are there, which are small cap to mid cap. So everybody concentrates on that, and as usual, when it goes up a little, more money comes, which should be contrarian to what we think. But actually, when the market goes up, the risk increases. But people look at last 1 year return or 2 years return and say, oh, this is fantastic. Even last quarterly return. And unfortunately, when you do CAGR and you have last 1 year return something like 40%, then what happens is your 3 year return, 5 year return, everything gets warped by this 1 year return. So everybody thinks, oh, small cap is giving me so much, so let me put more money. So out of the 15,000 crore SIP book, a big portion comes into small cap. So small cap, you have lesser number of companies in which people can invest and more money is chasing. And what happens when there is lesser supply and there is more demand, price goes up, that's all.
But there is another point which has been made out by a lot of people, that doing SIP in small cap is not risky at any time. Any thoughts?
I don't know. I think we have to get some of the basics right. Equity is risky. This does not change. Whether you come in lump sum or whether you come as SIP, equity is risky. So equity is risky, you have to drill it into your head. And taking 10 year, 20 year, 30 year views is very easy, but you do not know how you will be after 3 years or 5 years. Maybe a 10 year view may be right, but what happens if your own cash flow is not willing to support that? What happens if you need money after 3 years, 5 years? Will you be able to pull money out? I think the risk reduces a bit, the standard deviation goes down a bit, but risk can never be eliminated in equity. I mean, tigers are wild animals, that doesn't go away. You are sitting in a jeep, you are hoping it will not attack you, that's all. It is not to say it's a domesticated animal because it is seeing 100 jeeps a day. It is still a wild animal, you have to be scared. Equity is risky, it is not meant for the person who cannot take a high standard deviation.
But the problem that I have seen in the last 2 years is that on the one side, valuations collapsed because of geopolitical or whatever, geosocial or geoeconomic event, however you call COVID, right? An event, a global event. And the way we responded to that event was quite extraordinary, in the sense that first we stopped most of the economic activity except consumption, because you have to live, and then we restarted all the economic activity. This stoppage and restart created a lot of supply side issues in several industries. Some industries started in some geographies, did not start in other geographies. This created a advantage for geographies where it restarted, because people were able to charge more for their products, get a higher margin and stuff like that. The market actually reacted to all of this by kind of assuming that these profits, these valuations, these supernormal profits were for a longer duration of time. So the P ratio has expanded from literally very low numbers to very, very high numbers. So what you are saying on the standard deviation has two dimensions. One side you went negative, other side you went positive. And this swing from extreme negative to extreme positive created a 1-year return in 2021, which was so high. And based on this 1-year return, capital flowed into small cap at a velocity which I have not seen in my investment experience. When capital flowed at this velocity into small caps, which is quite extraordinary, that further bumped up the return, and again, as you mentioned, more capital flowed into this. The institutional response was to take the capital. Nobody said, I'm going to close my fund. Some people said, I'll stop the lump sum, but I will take the SIP, which is what I alluded to in my earlier question. So when this kind of a thing happens, you have one-way buying that has happened for nearly 24 months. And this one-way buying created NAV in the mutual fund, performance in the PMS, huge rise in the small cap index, and a FOMO amongst the retail investors who are not part of the institutional investment framework. Those who are on the Zerodhas and the various platforms, Grow, Upstock, and various other individual investors who are literally small investors who want to on their own discover the joy of making the same returns which the index or these institutional guys have shown. So when you see that somebody has done, you also feel, why can't I try my hand at this? It's a natural human tendency. So these guys came in last actually. I would say most of these guys have come in the last 12 months. And all this created a bigger wave of one-way buying. Hardly anyone has really sold or booked profits. That's the sense I get. Now, when the markets cracked in the last few days, I don't think any of these players were thinking that this would happen in the way that it is unraveling. So now everybody is unprepared. What I am sensing is that a lot of people have invested in this small cap thinking that let me buy and keep on buying till it goes up. And when it starts falling down, I'll sell and get out and keep whatever profit I want to keep. How do you think this behavior will affect the behavior of those who are doing SIP and who want to believe in the 10-year small cap story? The guys who are going to do this trade out will be only 5-10% of the total investor community. But they have created a sell side. Earlier there was no sell side, literally only buy side, going and grabbing whatever they could from Mr. Market. That was the 2-year thing. The 3rd year retail also joined. Now we are seeing a sell side emerge from the opportunistic profit bookers. How do you think this opportunistic profit bookers will affect those who are the long-term investors?
See, one thing happened in April 2020. If you had done a survey, I don't think even 10% would have said we will recover in 1 year. Nobody expected, except the super bullish. Maybe we would have even called them foolish, because when you spoke to pharma companies, they said at least 2 years to discover the vaccine and all. So nobody was talking of less than 1000 days for a recovery. The market recovered in 90 to 120 days. None of us expected. Huge flows. If you see the account opening in the Zerodhas of the world, tremendous amount of accounts were opened. So many new SIPs were started. And the SIP industry or the mutual fund industry had a theory that when the market goes down, you should put more money. Now, one category, income stopped, right? Completely stopped because companies were laying off, etc. But for a big amount of the rich, the income didn't stop. Income actually may have gone up, right? So they started pumping in money and the market recovered. Maybe in April, you thought the market will go down. By September, October, it was hitting all-time highs. Nobody expected this. Anybody who has been in the market, Shyam, from 2003 has not seen a long fall. So now also when this fall happens, people will come in with a frenzy till it falls further. Then they may panic. But the industry is going to say, look at our history, last 4 years, if you have done an SIP without worrying, even if you take April to September 2020, you wouldn't have lost money if you had not shopped your SIP. That theory will sell till the market really crashes, if the market crashes. So I think people will put money. They will get hurt, yes. Some people will sell because they will want to book profits, but they will come back as an SGP. I don't think they will sell and take the money and go to a large cap or to a liquid fund. That they will not do. They will say, oh, 10% fall, it's over, now let me come back.
So you're saying smart cap investing, for those who have tasted huge success in the last 2-3 years, is here to stay.
It is here to stay because a small proportion of our population is investing, and every bank which opens new branches goes and sells SIP. So yes, some people may say, oh, let me put into a balance advantage fund or things like that, but largely what is sold is mid cap and small cap. Some direct investors may go and put in large cap and all, but large cap is never pitched. Because say, oh, large cap you can put in an index, small cap you put into this fund, mid cap you put into this fund. I don't think those people will disappear, because the industry will again say this. Keep putting for 5 years, keep putting for 10 years, and people will keep coming. I don't think the impact on the SIP investor is going to be huge.
I'm seeing a lot of investors panic in the past 7-8 days. But I must say the previous 60 days I saw investors panicking to buy.
Correct. It's FOMO both sides.
Both sides I'm seeing the swing very sharply, and maybe as you are saying that again they may sell, and then again when the market falls they may panic to buy also. So overall it's bouts of panic on both sides that I am seeing, and I feel that one should not be much affected by this. You should be very small specific. Being a small cap investor for a very long duration of time, most of my experience is in that space. I get the feeling that the mental preparation that is needed for the next 3 years to be a small cap investor is of a much higher order. I feel that you should be far more patient,
Yes.
far more gradual, far less expecting, far more incremental. You should not put all your money in one day. Like I've been telling you how one should place orders. We've been discussing this last one day. And slowly you buy. If you want to buy a stock at 45 average, you start at 50 and buy to 40. You don't start at 45. Because the time it gives you from 45 to 40 and back to 45 will be very little to buy the quantity you want to buy. And if you are an institutional investor or a PMS where you have to deploy in each stock 25 to 50 crores, then I don't think that the traditional method of buying from another seller, bulk seller, is going to work now. For the simple reason that everybody knows the value of what they are owning. This is a well discovered market, and it's a more efficient market today than it ever was. So the only inefficiency in this market comes from the panicking investor. It's not coming from the large investor.
Can't come from the large.
But it used to 5-10 years back. Maybe 10 years back it used to. 5 years back it used to in certain pockets. Now I see less of that panic in the institutional investor unless he is having redemption. Today I think that support or the balance between a selling investor and a buying investor is keeping these institutional guys quite comfortable. If somebody goes out, 2 people come in. So overall, this is a market where one has to be much slower, much more persistent, and much less reactive.
True.
So in that sense, one gets a feeling that despite all the events which have happened in the last 3 years, some of which we are critical about, the market is maturing constantly and the investor is maturing constantly. And the institutional system is getting a clientele which is more mature.
Which is learning.
Right. So while people think that PMS, mutual fund, AIF, whatever, index investors are all those who are taking the support of a manager and thereby they are not strong, actually they are the stronger ones today the way I am looking at it. Now I am going to ask you a question about the weaker ones in this market. 9 crore accounts have been opened And out of the 9 crore accounts, Demat accounts, 6 crore have money less than 10,000. This is a statistic I picked up from a Finfluencer's Twitter handle. This is not data I have collated, I just saw it on Twitter. The person has a few lakhs following and I have been seeing his opinion, so I assume that he is right. So if 6 crore accounts have less than 10,000 rupees in their Demat account, worth of shares in their Demat account, I wonder how these kind of investors are going to make informed or calculated decisions in the space like small cap which they so aspire to invest. It's fair to assume a lot of their money will be in small cap, right? And I have been an investor like that before. Maybe not 10,000, maybe I had smaller amount.
Maybe you had 10,000 30 years ago. So
in today's world.
In today's world. So yeah.
So the point is that I have seen that it's very easy to make mistakes when you have less money also. But people want that experience of making those mistakes, thinking that they will learn to become better investors. I'm sure some of these 6 crore will become. But it is fairly simple to generalize that most of them will have an underwhelming experience, an experience which is not a happy one. Why do you think we have actually pushed so many people into doing something on their own without adequate preparation? Because we have a far more robust, resilient system today. We have good regulation, we have good management. By and large, the system is far more resilient today than it was 10 years back. Yet, why have these 6 crore people not thought of becoming investors within the formal system of fund management or index investing, or, you know, why have they chosen to go into?
No, I think it is, first of all, I think we are not making enough distinction between investors and traders. These are the gaming experience people. So they want to get in the morning, do something and have the thrill of action.
With 10,000.
With 10,000, because that's what he can afford. He's doing it without money also when he's playing video games, right? There's no money, but he's still playing video games. For them, this is more a video game. They don't even know the name of the company. They pick it up from somewhere, they buy, and if they make 1 rupee, 2 rupees, whatever.
How will small cap be affected by these guys? Small cap investing be affected by these guys?
I don't think it will have great impact because they will not buy one share, right? It's not, the worry is, first of all, I think investing is a solitary game. You have to do your investing, I have to do my investing. We can talk and all that, but we can't copy each other. Now, I give this example of group study. When you're not at all prepared, you call up and I say, I'm also not prepared. Then we all sit in one house, we drink coffee, we do all that, but we still don't study. We feel secure. He's also not studied, I have also not studied.
So you put the 6 crore in the group study concept?
Yes, group study concept. They don't know what to do. They get in with another person who doesn't know what to do and they'll say, we will do some joint investment. You buy this, I buy this. If we both do well, we will share it half-half. These kind of games people are playing. And people are enjoying the experience of execution is so fast. Once upon a time, you have to call the broker. He would say, oh, he's gone into the ring. Today, if you can do it online, it is fun. So, at the end of the day, if you make 40 rupees, 50 rupees, he's happy doing that. So, I mean, I call them voluntary contributors to the broker welfare fund. That's what they are. They are. You think they are investors, they are not. Even the regulator calls them investors, they are not. They are traders.
Also, they have been told that you are paying cost to the manager, whether it is a AMC or a distributor or whoever. Yeah. But in a market like this, in one day they will lose 3%.
No, but tell me one thing. Annually, if I have to pay 1.5%, okay, for the competence of a, or the supervision of a Naren or a Prashant Jain or an Anand Radhakrishnan, is it too much? Why would I not pay? He's protecting me. I have to see it as a protection come growth, not just growth. Just growth maybe I can also do, but I don't know how to protect my portfolio. I do not know portfolio sizing. If you think an IFA is only there to pick up the fund, it's wrong. He's there to do your portfolio sizing, analysis and all that. Therefore, a fund manager, therefore a fund rather than a individual stock for these people. But this gaming experience is a big problem. So if you see how easy it is to execute on these new platforms, people are having fun. Incidentally, if they make money, great.
I have been advocating booking profits in small cap, taking money out through SWP. I think you have also been saying this. Naren has been saying this. mainly to caution people that, hey, you had a great time, you've done well also. Protect some of it so that you can again repeat the same thing by starting somewhere lower, maybe at the bottom or closer to it. Not been well received, I must say. Now it's come down. Now the same people come and say, you told me, but all others were telling like this person was telling like this influencer was saying like this Twitter handle was saying never sell. And then they'll say that Warren Buffett has said this. A lot of defense mechanisms are going to come out. But tell me that if somebody has missed till now to take their money to safety, what are your thoughts on what they should do even now?
If you have been doing an SIP in small cap since say 2020 or something you started, you can see your IRR there. And if you see it at 34%, let's say I was just seeing in the morning and in one of my funds it is at 34%. It's a fantastic time to get out. Don't think you're 2 days late. Maybe you're 28 days early. So I have a very simple theory. If you want to panic, panic fast. Don't wait for the last day to panic. That's the worst time to panic. So panic now, it's okay. But don't do an SWP, remove a lump sum. So if you have 5,50,000 lying there, remove 2 lakhs and take it to safety. How to take it to safety? You put it into a balance advantage, liquid or multi-asset somewhere. You take it to safety and then continue your SIP. Don't stop your SIP. But taking something out when the return is 34%, when your expectation is 11 or 12, you get it 2 times that or more than 2.5 times that return. Isn't that fantastic? Which world are you living? Incrementally, you're not going to get 34%. This 34% is because your starting point was very low and the PE has gone up and the EPS has gone up. Now the PE from 10, let's say the PE has gone to 22 or something like that. It is not going to go from 22 to 42. So the PE expansion in your return is gone. It's over. Maybe it can come down. The EPS growth has to happen. So then quarterly look at the results. If it is not happening, continue your SIP, but at least remove a lump sum.
Is that in markets like this, liquidity is the king. Investor who has the liquidity is the king. So having liquidity is probably far bigger strength than having notional gains. So that is one point which small cap investors can remember today. And success is also meant to be protected and preserved in the most effective way possible, because it's not possible to be perfectly ideal, but given that there is room for imperfections, accept it and still do what you need to do for your portfolio. These are some of the thoughts that came to me based on what an investor should have done, has failed to do, and what he can still do before it is too late.
See, there is one more thing. I know some of the small cap fund managers, they're extremely, really brilliant, and they know that they will have a liquidity problem. So they are very careful that they wouldn't put more than 3% in one company over 70, 80, 90 companies, even when they go to 27,000 crores and 30,000 crores.
Now they have 45,000 crores, 42.
Yeah, so they're managing it very well. And they also know that when panic hits the market, they will not be able to liquidate some of the stuff that they have. That is, liquidity problem for the fund manager also can come. So if there's a redemption pressure, you will take a hit in the NAV. So you have to be ready for that, because today you are seeing 34%, then suddenly you will see 29 and you may panic. 29 is not bad, but you will panic because you have seen 34. That anchoring will happen, so you will panic, you will get out. So therefore 29 will become 27 for somebody else, that guy will panic. You have to be ready for all that. So when you say that you can do an SIP over the next 3-4 years, you should have the equanimity to be able to sit and say, I know my expectation is 12, this is 2x my return. If it comes down to 18, I will still not panic. If you have that ability, you can continue. But ask yourself, do you have that ability to sit tight when everybody is panicking? If somebody starts panicking after a month or 2, will you then sit tight or will you panic? If you're going to panic, panic today. Don't wait.
So we have made sense of what one should have done, what one should do before it is too late in small caps. Making sense of past events is very, very important, because we should understand what we did, what we failed to do, and what we should have done. In the next video, we are going to discuss how we should view this space over the next 3 years. So the past 3 years we have discussed in this video. In the next video, we'll discuss the next 3 and what we can expect, what are the surprises which will come our way, so that we can be better prepared to face those surprises, better prepared to respond to them, better prepared to participate in small cap investing as a genre, and also to expect correctly from small caps. I don't think what we have seen in the 3 years is going to play out exactly in the next 3. It could be a very different phase. So let's prepare ourselves better for that phase, and the next video will delve into the future. Thank you for watching this video. Do watch the next video also on small caps. Thank you, Subra.